Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of the Options Playbook, and I'm going to be your host here for about the next 25 minutes here on Options Guide TV. Well, we're in October, and once again, the markets just seem to struggle, and that's what we got going on today. So we decided, I guess, I consciously made a decision to do a little bit more short trades in October, in the month of October. And the first one that we started with at the very end of September is a VIX trade that used call options, looking for the market to go down because of the inverse relationship. And we're going to look at that trade again today, probably close that one out. And then we last week we looked at Apple, and we actually got short Apple. Yep, we got short Apple. We decided that that's what we wanted to do. And so far, so good on the Apple position. We're going to be getting into earnings. JP Morgan is kicking off earnings Friday morning. And then you got Wells Fargo also announcing on that day. To me, earnings season begins with JP Morgan. That's the financials are usually the company that garners the most attention are the financials to start off on the earnings season. So we'll look at some earnings trades just because why not, right? We're always looking on Options Guide TV to try to grab some of the plays from the playbook and try to apply them to certain situations. So on Wednesday, we'll probably come back and look at an earnings play in JP Morgan, heading into that earnings report on that Friday. And it'll be a very interesting one because we just had the Fed meet and they went 50 basis points. So to hear the comments, starting off in the financials in particular, JP Morgan in particular, which I do think is, one of the leaders in the financial space without a doubt, and see what their comments are, see what they're seeing in the marketplace based off of that 50 basis point rate cut. But we still have geopolitical concerns are by far the most concerning things here. And energy stocks are still doing extremely well. We saw ExxonMobil actually break through to an upside, and we'll look at that. I mean, I guess if I were to get long the marketplace, we could do it in ExxonMobil. We'll look at the chart and let's talk about that. So let's start. Let's zoom out or zoom in, I should say, on the Tradier Pro software. And by the way, if you have any questions, feel free to put them in the chat box. You got to be logged in either to the Tradier hub, hub.tradier.com, or go to the YouTube channel and log into YouTube, and then you can ask questions directly via the chat box. And here we are. Here's Apple. So this is what our thoughts were last week in Apple on Friday, and I'm going to zoom a little bit here. Okay, resistance is right at this level. A lot of chop in the marketplace. Look at this chop, all the way through. But Apple needs to break out to the upside, and then obviously if it broke through this recent all-time high, then you'd want to flip the script and maybe get bullish. Now that's just based off of the charts. You can argue about the fundamentals all you want, but this is why we're doing this trade, and we're doing this trade in the short term, is that you're getting some decent premium at the 235 level for just doing a 1-by-1 short spread. And the market has came down. So if we look at that trade real quick, let me grab it from the what if calculator. And we froze for a second. There we go. So in the what if calculator, if we grab this trade, this is where we're at. Last on the underlying stock is 224. And this is the VIX trade. So we'll move that out of there. And here's where our risk kicks in, right at 235, right at that support level, which in the support level, if you're rounding off, is about 233, or resistance to the upside. Should get that. I went reverse. 233. So you're right about here is where that resistance level is to the upside. I'm kind of expecting just a little bit more chop in Apple heading into their earnings at the end of the month. It is earnings season. So we, in particular, picked the 10/25 expiration because the anticipated earnings date is October 31st in Apple. We went 5 points wide, and right now the market is down a little bit in Apple, or unless it's changed. It was down this morning. So let's grab the what if calculator. Let's send it to the trade ticket, and let's go over to trading. Here we go. Yeah, so right now we sold this trade. We're making a little bit on it. Okay, so at one point, so when I looked at it this morning, it was at 51, and that's where that limit price is. Now it's at 64. Market in Apple, AAPL, is down $2.13. It's trading at 224.67. So at this point in time, we're just going to stay the course. We are going out to this expiration date, and you can see the difference in implied volatility. It's already starting to skew a little bit. So implied vol here on the October 25th is at 22, and November is 25, and we're up. Now it's only a dime. So we were up a quarter at one point in time. Interesting. Now, if I do have this trade in, and once I put it on, I always like to put a closing order in. If I can buy this, let's say 15 cents. The way I look at it a lot of times is you want to get between 80 or 90% of the net credit received. Very rarely do I get the all 100% because the last nickel or dime is almost impossible to get, it seems, in the option trading world. So why stick around and try to get it? So right now, if I have this position on in my account, I would have an order in to make sure that I'm going to buy it back. And you can pick that number, 10 cents or 15 cents, put it on for 75 cents. If the math is simple, if you can get a trade done for $1, you're talking 15, 20 cents. That's where I'm always going to close it. And that's where my math is as far as that trade is concerned. If it starts going against me, well, then I'm prepared to either adjust or close, really depending on where it is in the expiration cycle. So right now, staying the course, it's not going up, it's not going down. It's just staying right there, right at that 225 level in Apple. And I do, we're hoping that happens. Give us another week at least of time decay in this trade, and then maybe look to be able to close it out closer to the numbers that I was mentioning. Okay, so then that is the Apple trade. Now, the one that I enjoy talking about the most is looking at the VIX butterfly. I like this butterfly. I like the looks of the profit and loss graph. Let's first of all send it to the trade ticket. So we have the quote down below. And I'm going to zoom down here. Okay, so as far as the spot is concerned, we have jumped up a little bit. We're at 20.84 on the spot. Well, and I guess I'll go back and look and see where the future's at. Let's see where the futures market's at. Now, there's an article that I have written, and I don't mean to be redundant because I've said it many times. It's in my x.com profile. Handle is @BrianOverby. You got to scroll back a little bit, but it's called Decoding the VIX. And what it talks about is the fact that the expiration or the option contracts are based off of the price of the future. So now you got to kind of figure out where the future's at. And it's very simple to pull up a quote and look at that expiration that you're trading, which is going to be the 9 days away. And this is our trade that we have on, and see where the quote switches. So right now, the futures contract is fairly close to 21, mainly because you look at the ask of the put, it's at 158, and the ask on the call is 152. So we're pretty close to 21. The actual VIX index is at, it's about there too. So we're trading just very close to where the spot is at, which is the actual VIX index on the 16th. And if we look at it, we're right now at $1.75. We paid 75 cents for this trade. We said on Friday that we would like to go into Monday and see where we're at. So we got the S&P 500 down 20, or about a third of a percent today. So let's close it out. We've done pretty well on the trade. It is 11 o'clock Eastern time. We said on Friday we would like to see what happens on the open on Mondays, because Mondays in October can be scary days. if there are market crashes, they usually seem to happen on a Monday. Not always, but they usually seem to, the big ones at least. And so here we got it at 174. We're up $1 on our trade. And on Friday, I went through great pain to kind of talk about if I have a 1 lot, I'm going to just get out of this trade. If I had a 10 lot, I might sell 7 of them and let a few of them ride. But in this instance, we're up $1 on the trade. We've more than doubled. We paid 75 cents for it. So we'd flip the script. Here's how we'd get out. We go in, this would be a sell to close. This would be a buy to close. And this would be a sell to close. And we do it right now. It looks like $1.69. Close that trade out and we're good and we're done. That simple. The only other thing that you can do, which I don't really recommend, is you can close this in spreads. You can go in and you can close the long spread and let the short spread ride and give it a couple of weeks. You got 9 days to expiration. So by the end of the week, there's going to be a lot of time decay. So if you're okay with being short a 3-point wide spread, that's not a bad way to go. And actually, let's look at that. Let's see what that trade is at. I personally wouldn't do this trade, and I want to emphasize that. So you could sell that right now for $2. So you get a little bit more on it, but then you have the risk of being short the 23 and 26, which is 3 points wide. So your risk would be 3 points wide. You paid 75 cents for the trade. You would be bringing in a net credit of $2, and then you would be hoping that the marketplace stayed below 23. This is why I love butterflies. I love butterflies, and I love butterflies because they're made up of 2 spreads. So you can be in a spread, leg into a butterfly, or you can be in a butterfly and leg into a spread. And so if this were the case, and we close this trade out, right, this one goes away. This leg disappears. You still got one more of the 23s, and then you would be long a 26. So this would mean you are short and you are long. And right now that's trading for about 31 cents. Not a ton. So you're taking in a little bit more risk to do the trade, and you're going to make, well, basically 30 cents because you would have had to buy that trade back to close it all out. And that was the difference between the $2 and the $1.70. That's exactly where that comes from. All right. So 2 different options on how you might want to close out the VIX trade. I personally put it on as a butterfly in this instance. I'm not down on the trade. I would close it as a butterfly. The VIX is a scary little thing. I don't want to lose that profit that we made on that trade. All right, so we did the VIX, and we also went out and did the Apple trade. Now let's go in, and if we're heading into the earnings season, and we have JP Morgan at on Friday, we can look at it. I don't mind getting long some option contracts. If the one industry that is going up mainly because of the geopolitical concerns and what's happening with oil, even though oil isn't really knocking it out of the park, it is moving. It's moving to the upside. It hasn't done much. As I mentioned with XOM, the chart looks interesting. I mean, I do think that if which we'd like to happen, but if the geopolitical concerns go away, which that's not going to happen in the short term, but I think XOM would probably pull back. There's no doubt that this is what's driving it. But I want to show you the chart in XOM and why I think it's interesting. And in XOM, I actually, in my own account, flipped the script because just like in Apple, we had a strong resistance level. So let me pull this up. Come across here. Let's look at this area in the chart. All right. So right here, there was a very strong resistance level going all the way back to April when it first broke down below that level. And it came back up and touch. And as we know, I don't know, You can't always assume things, but the more that underlying stock, as far as charting is concerned, touches a resistance level, the harder it is to keep that as a resistance. It's the harder it is to beat the stock back down. And there were many times. So it came up, and not only did it gap up like strong, it closed up above that resistance level right at that 120. I'll call it 120. My resistance line is 118, 119.84. 120 is really where I was targeting, and has continued to go on up. So I think it's safe to say that that's a breakout. Set an all-time high right here, and we're now at 25. So to trade the breakout, and we're still in October, but if you want to try to do the momentum trade here, I don't mind this trade. We're earnings is still at the end of the month, and I don't really want to be involved in earnings. So we're gonna, I think, earnings. 9:30. Okay, so let me double check on the earnings where we're at and figure out exactly where it's at. I'm going on a tangent here, but I don't mind this trade. I was short, and here's a great example. I was short a short spread right here, and when we broke out strong to the upside, I bought an additional call. In other words, when I sold the short spread, I received about $1 for the trade, and then went out and bought an additional long call option. And the market has gone up. And actually, if you were in the, I'm out because I got out at break even basically. But if the market continues on up, you're long one more call than you're short. You're actually in a back spread on that trade. So that was my hedge. So now, especially right here was the ideal time, right when you broke out to the new highs, right at 123.79. That would be the ideal time to jump into this and get long. But I'd still want to get long. But I'm going to do it a little odd. I'm not going to get crazy with it. Let's see if we can see vol here. Okay, so I think we're talking, oh yeah, I think it's November 1st. Is when they're announcing earnings, right in this week between the 1st and the 8th. And you're starting to see implied volatility creep. So 26, 28%, and these are lower ranges. Short term doesn't necessarily matter. So let's go in and do an 11-day trade in XOM. We'll make this an official paper trade. We'll do this trade. 125 is where we're at. We got implied volatility at 24%. We're going to sell that. We're going to sell this at the money option contract, 26. And then let's go down 3 and buy this one. So we are doing 3 points wide. Okay. Let's go 4 points. I still want to sell that 126. I want to sell all that time premium on the most at the money option contract. Sell, and then let's go 4. Let's see where that's at. 250 to make 4. Well, I don't mind. I mean, I know we're just speculating. We're just doing something off the cuff here. I don't mind doing the 123. That's 3 points wide, and that's totally just managing a risk. But I want to sell this at the money option contract, and I'll stick with this. Let's ride with this. Let's send this to the what if calculator. And hope that the momentum stays. We're selling a lot of that juice, a lot of that time premium on that at the money option contract. We got a decent risk reward. As a matter of fact, our break even is going to be below where the underlying stock is at. So 122, let's call it 250. That's 256, 255. Okay. 122 plus 255 would be 124.55, and the market right now is at 125.70. So so this trade that we're putting on, I have an alternative. If the market does go against me, we're going to roll into a butterfly. But at this point in time, if we put this trade on, our break even though we're buying it, we're putting on a long call spread on this trade. Our break even is below where the current underlying is trading. So time decay is our friend. Time helps us out. The market stays where it's at here. We're going to be profitable on the trade. 125.75. Time decay could just kind of help you get to that level. So if I look at our trading scenario here, where we're buying this option contract and we're selling this one, we're buying $1 worth of time. This is extrinsic value, right? So that's intrinsic value minus the time value in the option contract. And we're selling all time value because this is out of the money. Maybe the market's right at one. No, not yet. 127. So we're selling $2.13 worth of intrinsic value. So whenever you do that, and we're doing that by selling the most at the money and then going down in the money options are going to have less time value than at the money. And so whenever you do that trade, that's a good scenario as far as theta is concerned. You're going to be positive theta on this trade and time decay. So I don't mind this trade. Like I said, if I look at the chart and we could pick our time or our ruthers, we'd rather do it right when we broke through this, right at 123.75. But I don't mind where we're at right now, hoping the momentum stays there. I don't want to just buy a call outright, right? Because I think it's got to settle in the underlying stock and decide where it's going to go to next. But that's going to be our paper trade for the day. Do we have any questions? Yes, we do. XOM earnings, October 25th. Is it really? We're still avoiding it, but it's the 25th. Is it set in stone at this point in time? But thank you for that. I think I'm still getting kind of a range, which is crazy, I guess. Let me check it out. Let's see where we're at. I thought it was November 1st. Yeah, according to Yahoo Finance, they have it at November 1st. It's not it's just the quickest one to be able to go and look it up. But November 1st is the earnings day. And the chart kind of looks more like that, even though this, I mean, gosh, just vol in general is high. And I think it's, mainly because of the news that we've had. But oddly enough, the 15th is trading at the highest implied. So that's what was kind of screwing me up, is there's really not a skewing of implied volatility. And that seems odd to me, considering what right now we're on October 7th. And I think you would start to see that skew. But let's ride it. Here we go. This is going to be our paper trade. Let me give you a read back. We are buying to open the 126 call with the 18th expiration. We're buying to open the 122 strike call with the October 18th expiration, at the same time selling the October 126 strike call. We're going to do this. Let's call it 260. Boom. All right. That's going to be our limit price. We could have got it for 250 when we started, but we're at 260 now, and that's going to be the official paper trade. And I'm going to screen grab that, and we're going to be good to go. All right. Any other questions that we have? Comments? I appreciate that. Thanks for stopping in. We're going to get into earnings season. It's going to be fun. I'm sad that I'm closing out the VIX trade because I like that trade a lot. And I don't want to do a rinse and repeat on the strategy, and continue to get more. I'm going to lean more bearish still going into that election. The election, I think, is everything. We need that unknown event as to who will be our next president in the U.S. To just go away and let the markets be free and fly, if you will, hopefully going into the new year. And that's it. My name is Brian Overby. I'm known as the Options Guy. If you want to read that VIX article, please check me out on Twitter, handle @Brian Overby, and we'll see you this Wednesday for the next edition of Options Guy TV.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.